Let me start with your top level concerns here. I mean, let me put it this way. If I didn't come to you obsessing about it, would you come to me?
One of the things that concerns me is the complacency that was in markets until recently. I mean, we really have had no economic landing. If you look at total payrolls relative to the total population, it's at a generational peak, and it's still outgrowing population growth. And I think one of the reasons we had this window of apparent resilience in the U.S. economy is that while the Fed was raising interest rates by 500 basis points plus, we also had a roughly 500 basis point expansion in the fiscal deficit from the summer of last year to the summer of this year. And so it's very unusual to see this kind of fiscal laxity at the peak of the economic cycle. And this is a real thing that markets are going to have to digest in the coming year or two, because we're already sitting at an 8% or so deficit. If we don't get a recession and the government has to roll its debt at the current higher level of interest rates, we could see double-digit deficits.
Yes.
If we do get a recession, we could see double-digit deficits. So
yes.
We have a fiscal problem right now.
You're exactly right. If we don't get a recession and rates stay here, we could see, wide deficits. And if we do get a recession, we'll forget it. I mean, that's traditionally been the way that the deficit blows out. Steve Leisman last segment was suggesting, and what happens if the Fed and the policymakers can't then come to the economy's rescue, although I tend to think the Fed will have no choice but to kind of restart that QE.
Well, that's the dilemma the Fed faces, because in its efforts to quell inflation at this point in time, they're risking a sovereign financial viability issue here. And so the Fed is facing financial stability considerations if we get into the kind of trouble that you're suggesting, and they're going to be caught in a difficult corner between re-expanding monetary policy or keeping rates tight. And I think if they do re-enter QE at some point, and we have these large deficits, and the whole interest rate carry story of the dollar comes into question, this will pose a real risk to the dollar in financial markets. And I think this kind of risk is not really being very well priced in equity markets at the moment. In fact, I can't remember many times in the last 40 years where you've seen this kind of move in rates and equity markets holding up. We saw it in 1987, didn't end well. We saw it in 1999, it didn't end well. And so I think there's some risk here in markets.
So it's so funny to hear you say all this and go, yes, but I'm buying blue chip companies, because a lot of people, this is when they break out the tinfoil hats and the gold bars. Although, gold is, I'm just looking back over the past year, year to date, gold is actually down as real rates have risen. Over the past year, it's up 8%. Do you think this deserves a place in people's portfolios now?
Yeah, so let me just sort of say in terms of why we own some blue chip stocks still, setting aside gold for a second, we acknowledge that the crystal ball is foggy at best. I've shared with you my concerns, the fact that valuations could come under pressure here, and we are indeed seeing a decline in market breadth here. But we don't know what the future holds for certain. And that's why we do hold gold as a potential hedge. And I think while gold is modestly off this year, it's really held up extremely well relative to the carnage that we've seen at the long end of the Treasury bond market.
True.
And so when you think of other potential hedge assets, gold is held in there very well. And I think often we see in the later stage of a tightening cycle, when liquidity conditions are tight, and as you pointed out, real rates are under upward pressure, the gold softens a little at the margin. But the question is, what happens next? When these higher real interest rates bite, when the economy rolls over, if it does, then gold will have its best days ahead. And the other thing I would just mention is that when you look at the worst decades for stock over the last centuries, that they've often been the best decades for gold, whether it was the 30s, the 70s, or the period around the global financial crisis.